2, 1.
New York, NY. LaunchPod starts now.
Welcome to the New York LaunchPod, a podcast highlighting new startups, businesses, and openings in the New York City area. I'm Hal Cooper-Smith, and in this episode we are speaking to Charlie O'Donnell. He's a venture capitalist and founder of Brooklyn Bridge Ventures. Brooklyn Bridge Ventures is a venture capital fund that invests exclusively in New York City startups, so it's a great fit for us. We have a wonderful conversation with Charlie. We talk about all sorts of things, why he invests in the companies he does, what he looks for in founders, how he started his fund, who his investors are, and a whole lot more. We even talk about our past guest in episode 8, Orchard, which Charlie invested in through Brooklyn Bridge Ventures. This is an episode you don't want to miss, especially since you're getting a perspective from the other side of the table. So let's go right to the interview. Stepping onto the LaunchPod, we have a real-life, living, breathing venture capitalist, Charlie O'Donnell. Thank you for stepping onto the LaunchPod, Charlie.
Happy to be here.
So you are Mr. New York, it seems. Let me make sure I get this right. You grew up in Bensonhurst.
I did.
Went to Regis High School, Upper East Side of Manhattan.
Yes, long commute.
And then you were up in Rose Hill in the Bronx for college.
Absolutely.
Have you ever left New York?
I have left New York on occasion. The little ankle bracelet goes off when I do. But the longest period of time I've been outside of New York City consecutively is 3 weeks.
3 weeks?
Yes.
Any reason for that? Is it like Speed and Sandra Bullock and Keanu Reeves?
I drove across the country at the time, and it was a really great experience. I highly recommend it. And the thing you want to do is go east to west, because the last thing you want to do is do all that driving and then wind up stuck at the Lincoln Tunnel at the end of it.
So 3 weeks was the longest you were outside New York City, driving across the country. And then you decided to start a fund called Brooklyn Bridge Ventures, and you invest exclusively in New York companies.
Yes.
Seems like a perfect fit for Mr. New York.
Absolutely, absolutely. And there's more than enough work for me to do here.
How did you come up with this idea?
So, the goal when you're in venture capital, or I guess I should back up a step, it's not like I grew up thinking I was going to become a venture capitalist. And Wall Street looms large when you grow up in New York. And so to the extent that I knew that the stock market existed, my godfather had given me some IBM stock when I was born. So I knew that stocks went up and down from, when I was about 6, and thought that that might be something that I would go into. So I was a finance major in college, but I actually wound up lucking out with a high school internship. Regis kicks you out in the 3rd trimester of your senior year, at least when I was there. I think they still do. And you had a choice of doing a community service project or an internship. So I chose an internship, and I wound up at the General Motors Pension Fund, which is a wholly owned investment subsidiary of GM that manages all their pension assets. A really phenomenally interesting opportunity for a high school senior to go and see how all these different asset classes get managed. Real estate and fixed income and trading and all of that sort of stuff. And the one area that happened to have an opening when I graduated was the venture capital and private equity group, which was a group that I had never worked with before. And it was actually very fitting for me because I went to college from, in the late 90s. I took an early interest in computers. My dad had brought a computer home when I was about 8. And to be able to invest in new technologies and get to meet all the people involved in that, which turned out to be a very fortuitous fit. And once you're in venture capital, the goal is to become a partner somewhere. You want the autonomy, the economics, the ability to, be at the forefront, to be at the board meetings, and to be a real key partner in trying to help these entrepreneurs succeed. And that's where you're aiming for. And sometimes those opportunities have to be created because funds aren't really advertising for partnership positions all the time.
So when did you come up with this idea to create your own fund that's based on New York companies?
So I spent 2 years at First Round Capital, and going in, it was actually supposed to be a 1-year thing, and I I was able to pick up an extra year for good behavior, and but after a while, I mean, they weren't necessarily growing as a partnership, and had a conversation with the founder, Josh Koppelman, who was the founder of Half.com and started that firm, and he said, you should do what I did, start a firm, put together a small fund, give yourself optionality, see whether you like doing this on a full-time basis, and where you want to go and what kind of investments you want to make, and then go from there. And you want to build a firm or you want to stay as a onesie, and see how far you want to go with it. And so that's what I did. And for me, the focus on New York was, obviously I was enthusiastic about the New York tech community. I was very fortunate to be early to it, to be one of the first 100 people at the New York Tech Meetup, to be the first analyst at Union Square Ventures. I really feel like I was here for the very beginnings of the tech community here. And it became sort of a self-reinforcing thing as a solo GP. How much deal flow do I want to be able to go through? Can I go through, right? If I raised my hand and I said I'm doing deals around the world, I'd probably get 10 times the deal flow to maybe do 10 or 20% more deals. And I have more than enough work to do here. I do 8 to 10 deals a year because the New York tech community is now the second largest venture capital community. So I'm not hurting for deal flow. I'm not hurting for good opportunities. So there's just a practical consideration that at this stage you're going to do deals locally. I want a certain level of involvement with the companies and to be able to help them make hires. That means obviously my local network is better than my outside of New York City network. And I think the other consideration for me was just sort of personal and specific to Brooklyn. Where did I want to put my office? I'm willing to do deals anywhere in New York City, but I live in Bay Ridge. I bought my apartment a few years ago. I like living there, and why would I put my office in the city? And that's actually a consideration that a lot of entrepreneurs are thinking about in New York. If they live in Brooklyn, why are they making the commute into the city? And so I decided to open up my office in Brooklyn, and that made me the first Brooklyn-based venture capital fund.
What type of opportunities are there for you to invest in companies in New York?
I think in the past people had thought about New York in terms of specific industries, maybe ad tech or fintech, but we've really seen a very big diversification of what's being built here. So just about every industry is located here. There's obviously a bunch of media and a bunch of commerce, but we're seeing technology-based startups grow here, database companies like MongoDB and Cockroach Labs, or companies like that are just starting with technologists, and it's due to the fact that Google's office in New York now is 11 or 12 years old, and there's a ton of technologists who have come from the banking world, who have come from the corporate world. There's people coming out of the existing startup base. And so New York's technology scene isn't homogeneous anymore, where we've got food startups and health tech and all that sort of stuff. So I'd say just about any industry is represented here in the startup community. And, I can't see there's any industry that can't be built here. So it's pretty diverse.
And you talk a lot about technology, but we were talking earlier, you also invest in some brick and mortar locations.
Yeah, absolutely. So for a long time, venture capital has mostly been focused on tech because that's where the growth plays have been. You're starting with a company that's 2 people and a prototype, and you're trying to sell it off in the future for $250 million or $500 million, or take it public for a couple of $1 billion. And most of those stories are in the tech world, but there are lots of stories that are brick and mortar retail rollouts. There are lots of stories that are, big CPG companies that are growing. And, historically, in the medium term, they weren't venture backed. But if you go back to, sort of early 90s, late 80s, they were. There are companies like Staples or food chains and stuff like that started out with venture capital dollars, Starbucks, and those became, big successes. And so I think we've seen a little bit of a return to that, particularly because of some of the direct-to-consumer CPG stuff that has that has happened and very successfully, right? So you have local stories like Warby, where they went with a direct-to-consumer model, and then they realized, wow, we're actually spending a fair amount of money trying to acquire customers online. It might actually be economical for us to open up a retail store, right? And so now Warby has a whole retail strategy. So on one hand, everybody's saying, well, retail is dead, but now you have these startups saying, well, given the cost to acquire customers online, it actually makes sense for us to be in retail, and retail is still an important part of our strategy. Companies like Canary, which I was the seed investor behind, do a lot of business directly on our site, but obviously we do a lot of business through our retail partners, through Verizon and Best Buy and Amazon, and so retail is really an important consideration as well.
So you wanted to go out on your own, start your own fund, and be able to be pretty involved in all your companies in New York. What were the steps that you needed to take in terms of taking that leap and starting your own fund?
Well, the most important step is the money, right? And so you could do the steps of incorporating legally and getting counsel and creating a website and a brand and all that sort of stuff, but without a money, you're not a real fund. And that was really hard, actually, because my network didn't overlap well with the types of people who would invest in funds. I had come from the General Motors pension fund, where my peer group was institutional LPs, right? So I had friends who worked at CalPERS or UTIMCO or the New York State Teachers Pension Fund, all of whom invest in funds with minimum check sizes that are 10 or 20 or $30 million. And so if I was raising 8 to 10 to start out, that just wasn't a fit for them. The other half of my network was VCs, who generally don't invest in each other's funds. And so I was actually a bit at a loss to try and figure out like who is the prototype fund investor. And there was a lot of trial and error in that process. I mean, I probably spent 5 or 6 months spinning my wheels going after some whales to try and anchor the fund, when I probably should have been spending more time just getting volume of people. And what I realized is high net worth individuals trade wealth for interestingness. They're looking to make money, but ultimately these are people who already have money. And a lot of the reason why they get involved in the startup community is because it's fun, it's interesting, you're on the cutting edge, you're getting to see hardworking founders take something from nothing to something.
You're seeing the band first.
Yeah, exactly. It's special, right? It's special in a way that a private equity deal isn't, right? Like I think it's probably fun to make a lot of money if you're Blackstone, but if you do it because you gutted the family-based management team and replaced Uncle Bob, the CFO, with a professional, and then outsourced a factory to somewhere, like, I don't know how fun that is. I mean, maybe it's fun, but I think it's a lot more fun to be at a company where day one at launch they have no customers. At the end of the first week they've blown through their projections for the first 6 months. That's fun. And it's also fun in the bad times too, and in a different way, right? It's what you signed up for. There are difficult decisions where you're sitting across the table and you're like, wow, maybe this co-founder's not the right person to carry this business forward. And if you counsel a founder through that and you walk out and you're like, wow, I did something good today, right? Like, help somebody. And it's difficult, but that's sort of fun in a different way. So it's the kind of thing that people want to get involved with. And I think one of the things that has helped me be successful in raising this fund is realizing that I'm not pitching, fund returns, and I'm not selling money to rich people. I'm selling involvement and engagement. We do a lot of co-investing with our limited partners. We bring them into meetings. We connect them to each other, actually. We just sent this survey out among my fund investors that's basically like, what are your interests? What things do you invest in outside of venture capital? Do you go on vacation anywhere? Do you have a house somewhere, right? Because maybe there's a group of my investors that all goes to the Cape or, summer somewhere or whatever, that they could get together over the summer and just, make business connections or friends or partners through their engagement with the fund. And I think a lot of that is just as important in terms of what they're looking to get out of it.
So when you were approaching people to invest in your fund, what was your pitch? Because you were first going out on your own.
Sure. I had a track record of 7 investments that I had made at first round capital. 2 of them had exited in the time that had passed since I was there, right? So GroupMe sold to Skype for about $70 million, and Constant Contact bought Single Platform for about $100 million. So 2 out of 5 had returned significant multiples on their seed round. So while it wasn't a very large track record, it was a pretty good one for a short amount of time. So I seem to be somebody, I always think about it like I'm sort of a big James Bond geek, and to get your 00 status, you have to have two kills. And I always think that second exit, when Single Platform sold, proved that GroupMe wasn't a fluke, that I seem to be investing in companies that are getting acquirers' attention, and so I must be fishing in the right spots. And on top of that, Refinery 29, who's literally just right down the street, actually.
Right next door.
Yeah, they're at 250, I think.
225.
225, okay. They're doing phenomenally well. They have hundreds of employees. Chloe and Isabel is doing phenomenally well. And so for a short track record, that was pretty good. But really, I tried to simplify my bet. So rather than try and convince you that I was smarter than this person or smarter than that person or had some complicated fund strategy, what I basically said is, look, I'm investing in the earliest of stages at the cheapest going in valuation. And if you believe that there are going to be a handful of impactful companies in New York, do you think over the course of the next 3 years that if I make 30 investments in capable entrepreneurs at low to single digit valuations in big enough markets to sustain big exits, that I will get into 2 or 3 of those? And, when you think about it that way, that doesn't seem like a really difficult bet. If you start to look at the landscape of who's investing in New York and how many seed funds participate that early, are willing to lead deals, and what does that competitive dynamic look like in New York, there just aren't many. Right? There's probably 4 or 5 seed funds that lead 60-70% of the deals here in New York, between me or First Round or Lear or funds like that. So it's not a difficult bet to say, I might get into 3 or 4 of those important companies, and the economics of a small fund are really friendly. You don't have to be in $3 billion exits to return your $500 million fund. At a sub $25 million fund size, 2 or 3 exits of a couple $100 million actually return the fund in multiples, so the bar is lower as well. And so I've set things up in such a way that realistic expectations actually get you meaningful returns.
How are you finding your deals?
The deals seem to be finding me, which makes things easier and harder. Easier in the sense that they show up on my doorstep, and I don't have to do a ton to sort of chase after deals and people who want me to come in. The hard thing is there's a lot of them sitting at my doorstep, and there's a vetting process. And I think it's mostly a function of I've been involved in the New York scene for a long time. And, the first tech meetup I ever went to was 12 years ago this month. And so being out there, being associated with successful funds like Union Square and First Round, blogging for 13 years next week, actually, and writing this newsletter for 6 or 7 years, and speaking and doing all these podcasts and all that sort of stuff. Like, if you're raising a first round, I'm probably going to be on your considerations. At least hopefully by now, you've heard of Brooklyn Bridge or me, or run into somebody who's had a good experience. You've had one of my portfolio companies, Orchard, on the podcast. And so by now, I've sort of cast enough seeds out there where you're probably going to run into me in some way. And I hope that the reputation is you're going to get a fair shake. At least you're going to get a definitive answer. If anything, that's, the worst part is the answer is going to be really definitive, and sometimes it may even border on a little harsh, but you're going to know how I feel about something. I'm not going to come back and say, oh, that's interesting, and you got to chase me down for a few weeks to see whether I'm actually coming in or not, which is probably one of the biggest complaints that entrepreneurs have, is everybody's sort of sitting on the sidelines and they're not really getting a definitive answer, which I've been there as somebody fundraising. It's really frustrating when you're following up with somebody for the sixth time. Are you in or are you out? Like that, just tell me no. Just allow me to move on.
So deals didn't just pop into you overnight. They didn't approach you overnight. 12 years, you said, in the scene, getting your name out. What were some of the things that you were doing, and how has that helped you now?
So I think the most useful thing that I could do to ensure future deal flow is just try and be helpful to people, because the New York community is very connected. And a lot of times, I don't even realize that I might have been helpful to somebody, but it's trying to do that maybe even in passive ways. So I'll find out, somebody mentioned to me the other day that the co-working space that they're in, they discovered it through my newsletter. And because they're in that co-working space, they found their CTO, who was just a onesie, operating on a contract basis, and they ran into each other in that space, and they're building a company together. And what did I even do? Somebody emailed me and said, hey, we're launching a co-working space. And great, I'll put it in the newsletter. I didn't even really give it that much thought. But when there's 12,000 people following along, actually that the ROI on that help is huge. So I think just that repeated, like, hey, is there anything I can do? But also trying to manage that, right? Because I don't have a ton of time. I'm just one person. So how do I kind of, scale that help? Trying to make the interactions a little more personal. So, for example, we've run every year, we probably do about 20 dinners, local neighborhood dinners, where we go and we pick out a spot and we say, okay, Gramercy, right? Draw a little circle around that and said, who are all the tech and startup community people who live in that spot? Can we get 10 people around a table? Can we get somebody to host and allow all these strangers into their apartment? We split the cost of a chef. The host eats for free. And you've got a designer, an investor, an entrepreneur, journalist, all sitting around the table and breaking bread with this great chef. It's fun, it's interesting, but you get to know people a little bit, right? And so two people will break off and have a conversation about, what kids they're trying, what schools they're trying to get their kids into, and somebody else is talking about the new CrossFit gym that opened up or whatever, and those connections are meaningful. And so I'll have people come back to me and say, hey, I don't know if you remember me, but I, came to the West Village dinner 3 years ago, and, I remember you do early stage stuff, and I'm building a startup, and I'd love to get your feedback on it, because I guess I came off like a halfway decently reasonable person to ask a question to, and maybe I'm the only VC they actually feel like they know that they've run into. And so it's that kind of thing, just slowly over a continual basis. And
12 years you've been building this network. Now people are approaching you. Mm-hmm. In terms of investing in a company, what's something that you look for in a company and a founder?
I think more than anything else, I'm trying to cut down the deal flow. I should go look this up because it's the second time I've used this analogy this week, but it might have been Michelangelo or Da Vinci, somebody who, was obviously at a level of their craft that anybody can only hope to aspire to, but that they take this block of stone and they cut away what is not the statue, right? Instead of making the statue, they just, cut things away. And I think of my deal flow like that, right? So as opposed to looking for positive signals, I actually try and look for negative signals, and I try and say, okay, well, let's cut away all of the companies where their market's not big enough, where even if they succeeded in doing the thing they said they were going to do, the hipster jeans trading site just there's not enough money and there's not enough people that want that thing, and so let's cut those off. Or
for the returns that you're looking for.
For the returns I'm looking for, right? Yeah, actually that's a good point. There are some businesses that are really great businesses for you to own 100% of, and who might, throw a couple $100,000 off a year or $1 million a year, but that's just not appropriate for a venture capital investor.
What type of returns are you looking for?
So it's hard to get venture returns, at least at my fund size, without getting exits in the $250 million range. And so if you're investing at single-digit returns, you're talking sort of the winners in the 25 to 50x category, because they have to make up for the ones that don't make it. And 50% of the companies aren't going to make it. They're going to be absolute zeros, despite the best efforts of smart, motivated people who make all the right moves, but the market turns on them, or they just don't do it fast enough, or they realize they're undercapitalized themselves because things were just harder or took longer or what have you. Another key is founder product fit. So there's some really smart people who are really capable, but their skill set doesn't match the particular challenges of the startup they try and create. And so I remember talking to a technologist who had helped build a company in the ad tech space who, I would want as my technical co-founder for just about any startup. And he decided to become the CEO of a consumer-oriented company that he had an idea as a consumer. And consumer startups are so hard to build because you got to have real insight, and just a unique set of things has to happen for you to be the person who comes up with the idea for Snapchat or what have you, right? That's a design sensibility. It's a sort of like human empathy kind of thing that you don't find in very many people. And if you're like, okay, well, my qualification for going into this is scaling an ad tech startup to 1 billion impressions a day or what have you, that may or may not be the appropriate design insight to go into a consumer startup, right? So, yeah, you're awesome as an entrepreneur, but not for this thing. And I think that's a key criteria where I'm sort of cutting away and saying, you're not the person I would back for that particular company, and that's a key as well.
So market size and product founder fit
Mm-hmm.
are the two main things that you're looking for.
Sure, and I think the other thing I would say is this workable? Is the idea workable in the sense that you're raising a certain amount of money to get to a point that we could all agree is either profitable, fundable, viable. So, have you researched this plan enough? And this is it's actually an executable plan, right? It may be, in the end, economically viable to build a time machine. But if you can't make any progress without spending $200 billion, there's no business plan that works for that, right? And if you won't find out if you're potentially on the right track until then, that plan just isn't going to work out. And so that's not a viable plan, and you're not really a realistic entrepreneur who can execute on it. So it doesn't sound like a big criteria, but workable plans cuts away a lot of these opportunities.
And at your stage of investing, certainly these companies are very early, may not have a product in or just launching. And so there's a certain aspect that I imagine that you're investing with an entrepreneur themselves.
Mm-hmm.
And what qualities in an individual entrepreneur are you looking for? Because some people who may be listening to this may want to know from a VC perspective, what are they looking at about me?
Sure. So confidence is really important. You need to be able to sell me not only on the opportunity, but I got to be convinced that you're convinced. Because I can't redo all of your homework. The homework that you did to start this company is 6 months old, a year old. Your whole life is leading up to this thing, right? Your whole career is leading up to this thing. And so...
Unless you're 21 and just out of college.
So that's an interesting thing, is that I haven't really backed 21-year-olds. And I've been more likely to back people in their 30s who can tell me a story of this is why I'm starting this company. That's not to say I wouldn't. When you're backing a 21-year-old, you're usually backing somebody who's already built something, right? You're usually choosing between somebody who knows something and somebody who built something. And at 21, I didn't know anything. So if I were to convince somebody to invest in me, I sure as hell had to build something, say, look, this thing is working. Where can I take it? As opposed to being able to do something, pre-product at that stage, because it'd be hard to tell a story based on experience. So confidence is a really big thing, because what VCs do is they extrapolate out their experience with you into future series of events. So however you're like with me, I'm imagining you're going to be like when you try and hire that top marketing candidate, when you sit in front of a reporter who's writing a story about you. And so if you're not convincing with me, how are you ever going to hire that sales candidate? How are you ever going to convince a reporter that you're the one to watch and you should be on that top startup list, how are you going to convince that Series A investor or Series B investor to invest $10 million when you have me on the fence at $350K? So that's really key, and I think that's something that a lot of people undercut themselves. I get pitches that are, hey, sorry, I know you're really busy, but if you can just spare me this amount of time. How enthusiastic do you think I'm going to be if you're hoping for 10 minutes of my time when somebody else is like, hey, I have this thing that I know you love to sit down and go over with me, for an hour. Natural human response to that is going to be, well, I'm probably going to be more likely to give time to the person who feels like they have something and they're confident about it.
Are you investing based off of a pitch?
Sure, I've absolutely done that. I've invested pre-deck. I've helped the entrepreneur build the deck to get other investors involved. Yeah, sometimes pre-prototype, and sometimes the company actually has customers too, so it spans the early stage gamut.
And you brought this up earlier. One of your investments is Orchard. That was our guest in episode 8. Talk about how awesome they are and when you realized how awesome they are.
I think that I might be the first yes that they got when they were pitching. They might have had a couple of individual investors, but I'm pretty sure I'm the first yes from a fund. Matt was introduced to me by